Hi everyone, welcome to part 3 of GetSpeed order flow. So basically today I'm going to show you how to analyze Get's order flow and how to trade it, combine it with convexity order flow. So in the previous video in part 2, we studied convexity order flow and we mentioned that it's a powerful tool, but when we combine it with Get's order flow, it will give you some amazing signals. And I'm going to show you how. And also, in this video, I'm going to show you how to change that futures linear mentality to a non-linear mentality of the options trader. That's a key on this analysis, right? So let's dive in. Gets order flow. When we visualize gets order flow, we see like this, like we see like positive yellow lines, like they spikes up on the positive side, and also they spike down, right? So on the positive side, that's what we call call gates. Basically, is positive spikes, that's positive gamma. But what's important here is that the cost of upside is lifted. What it means? Basically means that it's a positive gamma, positive gas, and the upside got more expensive. So for instance, in this level, options above this level, when the price is trending up, got more expensive, right? They got more expensive on the upside. But when we combine that with long gamma, it's basically is a sign for reversion, right? Be careful of the time of the day and the market structure. What it means? It means that if the price is moving up, we're trending up, and then we see, for instance, this big line like spikes up, and it's quite meaningful compared to the other lines. And we also have on the convexity order flow, we see a long gamma. That's a sign for reversal, right? That's what I mean by market structure. So for instance, if the market is trending down and we see a spike on the yellow on the positive side, a call gets, that's quite different because it's nothing to reverse, right? So I'm gonna show you later on. I'm gonna show you with some examples, but that's what it means, right? So use market structure. If market is trending up, we have a clear trend, and we see this positive spike, the yellow one, that's a warning signal. It's like someone is putting brakes on that trend up, right? Now, on the downside, on the negative side, is what we call put gets, right? What's important to know is that basically means that the cost of downside is lifted, right? So it's negative gets and the downside go more expensive. So this is a perfect example when combined with long gamma, although I don't put it here, but that's equal a reversion. Look, the market is trending down, and then we see some negative spikes. You see, this one is the first one, and this one is the second one. And these two put gets are quite meaningful compared to the put gets that we had before, in general, the gets that we had before. So basically, this is telling us, hey, wait a second, someone is putting some brakes on this move. Someone is changing the regime, right? And by doing that, they taking the liquidity here, and these options are becoming more expensive on the downside, right? And the algorithm of GetSpeed order flow basically showing us that when we see these lines and the market is trending down, this is a break. This is a sign for reversal, right? But be careful. Bear in mind that these spikes down, this put gets has to be meaningful compared to the previous ones. Okay, so we can say that gets order flow is actually directional. Now, again, just to remind again, so when we have a positive get, means that the cost of upside has been lifted. That's called gamma. That means that the upside go more expensive, right? So the market is trending up. So that's what I mean by market structure. Combine, always have a look market structure. So we have a trending up market. Then we see some positive gets, spikes. Remember, has to be meaningful spikes compared to the previous ones, right? This is a break, right? This is someone is changing the regime that we currently have, and most likely than not, and the probability shows that this is a sign for reversal, okay? Now the put gamma is when we have spikes on the downside, right? That's negative gets. So that means the cost of downside has been lifted. So the downside options go more expensive. So what it means, if we are trending down and we have the negative gets of the put gets spikes, has to be meaningful compared to the previous ones, right? So that's a sign for a reversal, okay? And the probability is high on those points. Now, we need to understand some key concepts, right? And this is, pay attention because this is the part when we're going to change that linear futures mentality into an options non-linear mentality, right? So what is order flow measuring? What is actually measuring? Basically, it measures the change in the state of the options change from T0 to T1, right? What is all this means basically? So we have gets profile, we have options profile, right? So in gets profile, we know we have imbalances of positive gamma and imbalances of negative gamma. And in options profile, we have buying of options and selling of options, right? It's very difficult for our eye to actually see all the strikes and kind of be aware when everything is changing in any of these strikes. What about if an institutional came selling, they take a short position in the futures market and they hedge their position buying a call, right? We don't see it here. It's very difficult to actually kind of see, oh, this guy is buying a call because it's going short in the options market. So this is what order flow does, and this is what is so clever because it measures the change from T0 to T1 in the whole options change, and it gives us everything in a nice kind of lines, like the positive, negative convexity, positive and negative gamma gets, sorry. And so basically it's like having some bird's eye here and have everything, we can detect when something happens in the whole options change. Now, what's the easiest way to remember this? So every time convexity spikes up, think of reversion, right? Think of friction. Some brakes have been applied. The market is trending up and someone is putting the brakes on that move. The market is trending down and someone is putting the brakes, right? So it's always the convexity on the upside, like the positive side. Now, everything is everything it spikes down, think of momentum. Liquidity is being added, right? Options are being sold. That's what it means. So options in the upside, options are being bought. So people change the regime by buying volatility. And when everything is when we have a momentum, I'm gonna explain it later, but options markets sell options, right? Because they like to sell options when everything is predictable. Now, and this is what I mean, option sellers profit when the price move consistently. And I think I mentioned before, but if the market is trending down like 1, 2, 3, 4, 5, and it's trending consistently in an orderly manner, option sellers is good. This is the perfect environment for option sellers because they're making money. Volatility remains predictable, right? So the implied volatility is equals to the realized volatility. So these guys, they make money by selling options, right? And that's what I mean by momentum, right? And we detect momentum when we see the convexity, the short gamma going, the lines going, the cyan bars going down in the convexity. But what happens if that 1, 2, 3, 4, 5 steadily, very constant move down, suddenly change? Someone came into the market, put some brakes, and changed that environment. So what would happen is volatility shifts unexpectedly, leading to large moves than anticipated. So in this moment, realized volatility is different than implied volatility. And the options market doesn't care about direction, right? They only care how smoothly or erratically price move, right? If implied volatility is equal to realized volatility, option sellers are happy selling options, right? But if something change, realized volatility is different than implied volatility, that's when the regime change happen. So by buying volatility mean expecting price to move different than before, and we can detect it here when we see the long gamma, right? Okay, so be careful with this because a trend doesn't always reverse, right? So basically, if we see the price going up and then we see some positive, some long gamma, right, in the convexity and long yellow gates, like cold gates, it doesn't mean that it automatically reverse, right? So basically, it just means that there is some stop there. It's been some brakes have been applied to the up move, right? And what we have to think is, right, some brakes have been applied and the market might move unpredictable or might pause, right, waiting for a new direction. So this shift marks a regime change, right, signaling uncertainty before the next move. But more often than not, it means that the market is going to change the regime, it's going to change the move. For instance, in this example, the up move that we're having. Now, more concepts that we need to think about it. So short gamma again is linked to momentum, while long gamma is linked to reversion. Okay, so why? Because when traders buy long gamma, whether through puts or out of the money calls, they expect the market to move differently than before. So if the market is trending up and they think they want to change that regime, they go and they buy volatility, right? So again, if the market is trending up in this case and is constantly and is steadily, this is a perfect like 1, 2, 3, 4, 5 on the move up. This is a perfect environment for option sellers, right? But if some institution came and wants to change that regime, they buy options, they buy volatility because they expect that this up move is going to change, that this steadily move. Remember, options traders, they trade volatility. So they basically say we're going to change that volatility regime, right? So the exact structure of the trade matters less than the expectation of change. That's what we have to think, expectation of change, right? So again, I put it again and I'm going to put it again. Long gamma is positive convexity, which means when options participants came and buy long calls or buy long puts, right? So every time we have this long gamma, every time it spikes up, think of reversion, right? And every time it speaks down, basically it's negative convexity. Options traders are selling options and think of momentum. Okay, so again, when traders buy calls or puts, they remove liquidity from the market. And this is something very important you need to remember and to keep in mind when you're trading. Okay? So basically this can increase the chances, of a price reversion because too many buyers at one level might eventually get caught and forced to exit, right? So long gamma often signals liquidity removal. Think of this always. Long gamma is liquidity removal, which can lead to market shift of regime change. And short gamma is often signals liquidity added, momentum from the current trend. Okay, so I've been explaining this so many times because this is the hardest part. Thinking as a futures trader, oh, the market is going up or it's going down. Now it's difficult to think in options trading terms, but that's what we need to do when we trade with order flow. We need to think of these guys are coming into the market, these options trader, to trade first of all volatility, and how these guys sell, in a stable environment. When implied volatility equals the realized volatility, these guys like to sell options, but if someone came and changed the regime, they change it by buying volatility, right? By going long gamma, and that is liquidity removal, right? And which actually leads to a market regime or a regime change. And when they sell options, they actually add in liquidity, which helps for the momentum. Now, again, if options are being both, liquidity is being taken, right? They buy options, they take that liquidity, and the price tend to move away from those levels, right? So instead of overcomplicating things with multiple steps, it's just easier to think in terms of liquidity flow. So how is that? So think of markets are drawn to liquidity providers, right? So when the options traders sell options, the market is drawn to these sellers of options, right? And the market likes to move away from liquidity takers, okay? And now market makers hedge their position based on liquidity. If options are being sold, liquidity is being provided and prices tend to move towards those areas, right? So that's it. That's why every time on the convexity we have a short gamma, the short spikes basically is momentum, right? So this is a very kind of way to remember this. And again, every time you see long gamma, positive convexity, if you don't want to remember all of this, just think that is a reversion, that's friction that is happening in the market. And then think of momentum. When you see short negative convexity, think of momentum. Now, how to trade this? You can scalp, right? But Um, we do not recommend the scalp on ears, right? We do recommend if you can scalp with this, you can take like 15 to 20 or 30 ticks on the NQ, okay? But how I found it is very useful. And the way is very useful if you wait for the price to hit a key level, right? We can see key levels in classic, we can see key levels in gets profile or in gamma in option profile. So if the price get close to those levels or actually touch those levels, then you keep an eye on order flow. What's happening, right? So by combining order flow with important gamma levels, right? Like the convexity ladder and gets profile that I just mentioned, you can determine if the coming flow support the trend or goes against it, right? So this helps to identify whether a level will act as a reversal point or not. Okay, I'm going to give you some examples, but the more you see this, the more take screenshots. That's what I do every night. Every night I take the screenshots from the day, right? And I can see this clearly. And on the next part, which is going to be, I believe, part 4, what we're going to do, we're going to bring different examples of different situations, right? Remember that you can use order flow when it's morning, right? When we have an event date like FOMC, CPI, stuff like that, and also you can also use it in a different way, like the last 5 or 10 minutes before the market close. Okay. So remember I said at the beginning, we need to change that futures mentality, linear mentality of bullish or bearish, and we need to change it to order flow like options terms, reversions and continuations, and how regime change happens when the options guys came into the market. Okay. Now, I know this is a lot of concepts to get in, but instead of focusing on being bullish or bearish, bearish, sorry, it's better to think in terms of trends. So are we supporting the trend? Are the option sellers selling options, sorry, and supporting the trend? Or if the market is going up or down, someone is coming into the market to put a break on that current regime and they want to change it by buying volatility. That's the questions we have to ask. So convexity order flow helps to identify if the market regime is shifting, okay? And gets order flow provides directional insights. So what's important to know is that index options we trade NQ or ES. Okay, so these are the futures from the indexes. This volatility and price, the volatility and price have inverse relationship. So when volatility drops, if you see the charts of the peaks, and then you go to the NQ, ES, or NDX, Qs, SPX, or SPY, you see that the relationship is inverse. When the peaks goes down, the indexes goes up, and vice versa. Okay, so selling volatility is generally bullish for indexes, right? But the key is to understanding momentum and reversion. If you want to trade with order flow, you have to incorporate this in your thinking. So what happened with unexpected events like major news twists or some data, CPI, worse than expected or better than expected? Remember that options participants, like options, they like to come into the market to sell options. They like to come to try to provide liquidity, right? Why? Because they expect the market to move, in a steady way. Implied volatility equals to realized volatility. But if something happens, on that event day, FOMC, data, you know, any one of those, if that change, and it changed very aggressively, what would happen is they can short volatility traders off war. All these guys selling volatility, they can be scared, basically, let's put it that way, and then they're forced to exit and increase the volatility. So they're forced to exit their positions and increase volatility, and that's when the regime change happens as well. Now we're gonna do I'm gonna try to explain it how we combine these two to have a clear picture. I'm sorry, I know there is a lot of concepts, so if you want to have a look this video one, two, three, four, 5 times, because all these concepts are important, and I know they're probably for futures traders, the first time they see all of this, it could be difficult. But when you see this, review this, right, and then go and have a look, convexity and order flow, and then everything is going to start to make sense, right? So now, for instance, what happened on the reversion? So price is coming down, okay? Then we have liquidity taking, so we have long gamma, and then on the downside, we go put gets, right? This is the perfect combination for a reversal. Why? Because the market is moving down, right? Someone is putting a brake on this move by buying volatility, right? And then when they buy volatility, they take liquidity, okay? And on top of that, Gets is showing us that the downside go more expensive because it's a put Gets, right? So options below this level are expensive, are more expensive, and on the convexity they show that liquidity has been taken. So this is the perfect environment, perfect environment for a reversal. Now, what happened after you take the trade? Okay, you take the trade, and then what you want is you want to see lots of spikes on momentum on the convexity on the downside. Why? Because remember the concept that we just explained. This means that liquidity is being provided, and when the liquidity is being provided, equal momentum, and that helps the price to keep going up in this example. Now, on the other side, if market is trending up, okay, and you see a long gamma, again, liquidity has been taken, but the key is the upside call gigs, which means the upside go more expensive. Okay, so when you see this combination, like upside liquidity taken, upside go more expensive, the market has been trending up and someone decided to change this regime by buying volatility. And when they buy volatility, they take liquidity and they make the options above this level more expensive. So the upside go more expensive, which is called gets. And that is a high probability trade for a reversal. Now, once you go into the trade, what you want to monitor the convexity and see these spikes on the downside. Why? Because it means that liquidity has been added and that helps the momentum. Now, I hope you guys like it. I know it's a lot of concepts, a lot of things to take in one video, but what I'm gonna do in the next part of this order flow series is I'm gonna bring some real, real life examples, and so that is going to help to make everything clear in your mind and help you to trade with order flow. Anyway, thank you guys. Thank you for listening, and see you in the next video.